Hey friends, how are you today? Welcome, new friends and old. Today, we've got a really great discussion that is near and dear to my heart. Covered calls, key considerations and misconceptions. Covered calls is something that I do every single darn day. I was just looking at it about a half hour ago for about an hour. Uh, Actually, not an hour, about a half hour. And it's one of those things that I think a lot of people have some misconceptions with. And that is a bummer because you shouldn't. You don't have to. So here's what we're going to do, friends. Before we get started, I want to make sure you can hear me because I don't want you to miss anything. So would you please go to the Q&A box and give me a big yeah if you can hear me. Please give me a big old yeah if you can hear me. Thank you, Mike. All right. All right. Thank you, Jack. Thank you, Dan. Um, thank you, Shane. Who else? Who else do we have here? Hold on a second. I'm missing people here. Wait a second. We got Jack, we got Stan, Shane. We got Mark. Hey, Mark, welcome. How are you, my friend? Long time no see. Been what, a week or something, I think, right? You usually attend these, don't you? Robert, welcome. Yeah, he says. Justin, welcome. Anonymous, welcome. Good. You don't want anybody to know your name. Keep that information private. People follow you, stalk you. They're going to get you. All right. Thanks, Dirk. Welcome. Joe, welcome. Yes, sir. Larry. Hey, Larry's here in the house. Yeah, boom. Okay. And Balaji, welcome. All right. Yeah, you guys are awesome, man. You know what? This is like this reciprocal energy thing, man. The more fired up you get, the more fired up I get. Let's rock. Okay. Holy cow, I'm getting into it, man. I don't know what's going on here. I've had a lot of I don't know what I've had. A lot of excitement is what I've had. Okay. My voice is clear. Yes, thank you, Bhaskar. Okay. Armin, yeah. Okay. Now, before we get started, I need to point out options are not for everyone. You should read characteristics and risks, standardized options before trading. Get a copy of that by emailing investor services at theocc.com. Now, I just saw a whole bunch of names of people who come every Tuesday at this time. You're part of the family, man. You're the core of the family, the immediate family. But you know what? I also saw some new friends here too. So allow me to introduce myself. So for those of you who don't know me yet, well, now you know me. My name is Dan Passarelli, and I am an author of a couple of the most popular option trading books. I'm part of a couple others, and I'm diligently working on my third solo project. And I've written a million articles and done 10 million webinars. I might be exaggerating those slightly, but maybe not that slightly. And I'm a trader. Traded professionally for many years. As they say, you can take the trader off the floor, but you can't take the floor out of the trader. And I still trade every single day. I'm the founder of Market Taker Mentoring, which is the global leader in option trader education. And I work with, honestly, I work with just about everybody. Great options friendly brokerages like Firstrade here, for example. Work with most of the options exchanges in the world. I've worked with all of the, at least parent company exchange operators in the United States, a whole bunch of them in China, Hong Kong, Had some conversations on consulting with, talked to the Brazil people a long time ago, Colombian people. Hong Kong Exchange owns the London Metals Exchange. I mean, I've worked with basically every exchange on the planet. And I'm a family man too. Let's talk about the important stuff here for a minute, right? Trading, all that can do is make you rich. The important things in life here, though, family, I do that too. Married to my wife, Kathleen, who many of you know. Those of you who are Market Taker student traders, you know Kathleen. She runs operations here with Market Taker. My 2 adult children. And I do other things for fun also, besides just trading and besides just hanging with my family. I'm a runner, foodie, traveler, been all over the world with my family or through Market Taker. And I'm a music person too. So that's who I am. Now, let's talk about the important person here, you. Why are you here? Well, to learn how to build wealth with options, I think, right? So I recently just launched a brand new podcast, and it's called Wealth Building with Options, and it's free. So go ahead and check it out. It will help you master covered calls and cash secured puts. It's great for wheel investors of all experience levels. You'll learn about adjustments, the mindset, which is so important to this. We'll talk about that a little bit today as well. Strike selection, analysis, and so much more. There's new episodes weekly. In fact, the newest episode just came out today with a very special guest, Russell Rhodes, who is a finance professor at Indiana University. He is a globally recognized consultant, super smart guy. And this podcast, this guest episode, Russell actually revealed some really great stuff that I didn't even know about some of the work that he's done, and you're going to love it. And the best part of this podcast is it's free. So you can go to Apple, you can go to Spotify podcast, you can go to any podcasting service on the planet, you'll find it. You can go to markettaker.com/applepod, markettaker.com/spotify-pod, markettaker or wealthbuildingwithoptions.com. Just find it and give it a listen, and let me know what you think. Leave a review for me, will you? Okay, now let's talk about what you didn't really know about covered calls. So covered calls, hey, who has traded covered calls before? Who here has traded covered calls or has not? Let's take a little survey here. Give me a yes if you've traded covered calls, no if you've not traded covered calls. No, says Shane. Oh, okay, interesting. Shane listens, well, you listen pretty much every week, don't you, Shane? Justin has. Mr. Secret Agent Man over here, Anonymous, says yes. Paula says yes. Jack says no. Mark says yes. Dan says no, but I will start soon. I'm going to tell you what. A lot of people think that because it's in investing, crazy markets are not good for covered calls, but that is such a fallacy. This market that we've been in right now is the best. I was going to say probably the best. I don't have to say that. It's been the best for covered calls and cash secured puts that I have ever seen in my life. So you're ready to start there, Dan. Robert says yes, and give the podcast a listen. It's I mean, right now we've got enough episodes where you can start binging it. Frank says yes. Michael, no, okay. Every week except for when work sneaks in. Work? We don't get work. We don't need work. We got options to trade. You trade, and dividend stocks and ETFs. Yeah, that's cool, man. And Michael says yes. Okay, good. Well, for those of you who said no or didn't answer because you're shy, traders shouldn't be shy. Traders are like, have bravado, man. Like, right? Don't we have bravado? Yeah, right. You've bravado. Gotta seize the, what do they say? Not caveat emptor. I don't know. I I never took Latin. Anyway, for those of you who said no, a covered call is when you own a stock and then you sell short a call. So it's a two-part position, a spread, where we're long stock and we're short a call. Call typically has a strike above where the stock currently is. And this is an investor-oriented strategy. Now, a lot of the things that I talk about here on the Firstrade show is trading strategies. I would go as far as saying covered calls are not a trading strategy. Covered calls are an investor strategy. Key difference. They're generally considered a conservative strategy, and the data show why. There's been a whole bunch of studies. I mean, JFGI, whole bunch of studies on how beneficial covered calls are. White papers, like third-party neutral bias white papers that prove it. They can outperform owning stocks outright while lowering risk. When you first started in options or investing or trading or just thinking, what's one of the first things you learned? Well, if I want more reward, I have to take more risk, right? There's risk, reward, right? Less risk, less reward. More risk, more reward, right? Isn't that one of the first things you learned? This, I won't say throws it on its head, but it helps you to cheat. Say, your risk reward is this. I don't know what this even means here, these two hands, but your reward gets to go up a little bit with this, and your risk gets to go down a little bit with this. That's pretty amazing. So why is this the case? Well, because when we add the call, we can outperform long stock. Now, that's universal. When it comes to options, there's always some sort of trade-off involved, or there's some sort of, if you get this benefit, you get this detriment. But the way we outperform is by improving what some people call the Sharpe ratio. We lower the standard deviation of our portfolio. What does that mean? That means instead of swings like this, we have swings like this. Okay? We're generating income on low volatility stocks or ETFs, and that's important. Most of the time, in fact, the context that we're going to talk about today, we want low volatility stocks or ETFs. There is a different technique where we can do it on higher volatility ones, but low volatility ones is what we're talking about today. And we lower what we call the cost basis, or what I'll call sometimes the tracked cost effect, or the tracked cost benefit. It's not the cost basis that you tell your accountant for tax purposes, but if we trade covered calls serially, which is not like the frosted mini wheats I had this morning. I had the mini ones. The mini ones are a little better, because like you get a few of them in a bite. Otherwise, you just get one, or, like you can't really have two. They're too big. But the mini frosted mini wheats, those are the way to go. But that's not what I'm talking about. I'm talking about serially, as in a series, selling covered calls. And when you do that, you own the call at this price, but you take in more premium. So it's like you own it for less. And you take in more premium, it's like you own it for less. Taking more premium, it's like you own it for less. It's kind of like if you go to buy a car. Well, let's see, what could you buy? Oh, geez, I don't know. Okay, say a car. And the car dealer guy says, well, there's tariffs or whatever. We can't lower the price on this car, but I'll give you $500 in cash when you buy the car. And you say, okay, well, that's kind of like buying the car for $500 less, isn't it? Or you sit down with the guy and he says, here, I'll give you $500 cash if you think about buying the car. And then you don't buy it and you come back a week later and he says, I'll give you $500 cash if you think about buying the car. That's kind of what it's like too. I guess that's more cash secured put, but that's the idea. It lowers effectively what you're paying for the stock. And this is one that is so underrated. Oh my God. When I listen to people tell me about their covered call strategies, when they don't talk about this part, I'm just like, oh no, you're missing such a key important reason for trading covered calls at all, is that, and this is a good one, I use this all the time for my covered calls to potentially set an exit strategy for a stock or an ETF. Now, let's put together a covered call. It's one trade, like I said, long stock, short a call. Buy the stock, sell a call. We can do it that way. Mostly for me, I like to do it on stocks that I already own. And I don't do it on every stock I already own. I do it on some of the stocks that I already own. Going through my portfolio in my mind here, I probably have covered calls on about 30% of the stocks that I own, 35% maybe. It's not made for every single stock in the world. It's not. But it's great for the right ones. Now, these two different ways to do it here as one trade, I buy the stock and I sell the call as one trade. That's what's called a buy right, because I'm buying the stock, and right is another word for selling in the options nomenclature lingo, cool way of talking. So I buy the stock and write a call. If I do it on a stock I already own, excuse me, that is a covered call. We all good on this? This is the easy part. This is the easy part. Okay. So most of the time for me, I'm doing it as a covered call, stock I already own. So I do this on a stock that I think is going to steadily rise as a conservative long-term investment. Maybe you want to buy it and you're going to buy it and then think about the covered call, or maybe you bought it a long time ago and you still believe in that stock. I want to lower my risk. In option trading, risk is defined as standard deviation. Now, standard deviation, I'm not going to get too hung up. I'm not going to get into the math of all this junk. If you want to learn about exactly how standard deviation is calculated, go to the Google machine and type in standard deviation and look at like the Wikipedia page or whatever. All you really need to know is standard deviation is a measure of volatility. It's a measure of deviations from a mean. Okay. It's like if you have red, and then you also have like pink and fuchsia and brick red and deep red. Okay, like there's not a big deviation from the main one, red, right? But if you have red in the middle, and then you have brown and green and yellow and blue and purple and orange. Those are big differences. That's basically what standard deviation measures. With stocks, it's like if it's $100 stock and, over the last month, it's closed at 101 and 99 and 99 and a half and 102, small changes. The stock's at 100 and over the last month, it closed at 55 and 116 and 83 and 122 and a half. Those are big deviations in price. That's all it is. So you want to have as low a cost basis as possible. You know what that means? Cost basis is, it's intuitive, right? It's how much you paid for the stock when you take into account all the factors. Like if you're going to buy that car and the car dealer says, well, I can't discount the price. You have to buy it at this price, but I'm going to give you $500 if you buy it. Well, in your brain, the cost basis of that car is $500 less from that sticker price you're going to pay, right? Never mind taxes and all the baloney they charge you. So yeah, we want to have as low a cost basis as possible. Covered calls helps with that. We don't expect the stock to break out and zoom higher or lower for that matter. We don't expect either of that. We think it's going to be a steadily rising conservative long-term investment. We expect it to steadily grind higher. Okay, so let's look at an example. I buy or probably really already own 100 shares of this stock that's trading at $70. And I'm going to sell, I don't own it, but I'm going to sell it. So I'm shorting this. I'm going to sell a March 75 call at $2 a share. So in this hypothetical example, March might have 7 days to expiration. It might have 30 days to, 35 days to expiration. It might have whatever. Now, and if we have time at the end, we'll fine tune on how to select the expiration and even strikes. What's the intent? Well, in this case, we're going to say, I prefer to hold the shares after March expiration. And I know as an investor that I like to minimize my volatility. Now, I can't control volatility. I can't control the actual volatility that takes place in the market, but I can control the volatility of the stocks in my portfolio somewhat. Seems kind of crazy, right? I can't control their price action, but I can control the deviations in profit and loss. And I do that by taking in premium. So I'm going to have less volatility risk during the life of this call trade. And I'm going to have a lower cost basis after the call expires. So let's take a look at this. So I'm long 100 shares at 70, and I'm short one of the March 75 strike calls at 2. That's when you say, bless you. Get it? At 2. Bless you. Okay. Sorry. I know. My wife gives me a hard time about telling jokes too. All right. So look, if I'm long 100 shares of the stock, thank you, Dan. See, I at least get something here. Thanks for throwing me a bone over here, Dan. All right. So I'm long 100 shares of the stock that I owned at 70 when I put this call on. And when I say owned at 70, I could have bought it 10 years ago after it split 2 times and own it for an actual cost basis of $20. But when I sold the call, it was at 7. Okay. Next, I sold one of the March 75 strike calls. So if the stock rises from 70 to 75, and it goes above 75, what is the implication of that short call? Who can tell me that? What is the implication of this short call? Well, when I trade a call option contract, okay, contract is the operative word here. Thank you, Aslan. Thank you, Paula. Both of you have the right answer. What is a contract? I mean, a contract is between two parties, right? What is a marriage contract? Two people get married, right? They have this agreement. What is a contract to buy a house or a car? Person and another party, the banker or the seller, whatever. I guess in this case, it would be the seller, right? You might have a different contract for the mortgage. Two parties. We are the seller. The other party is, guess what they're called? The buyer. There's a seller and a buyer. The person who owns the call has what? The person who owns the call owns the right inherent in the contract. The right to buy the stock. Thank you, Paul. The right to buy the stock at $75 a share, anytime between now and expiration. So the seller, which in this case is us, the seller has the obligation, or as a friend of mine calls it, the potential inevitability to sell the stock at the strike price at $75 a share. Oh my goodness. This is where people get really hung up and angry and feel they fail when this happens. You're telling me that a stock that I own at $70 a share, I might have to sell for an 8% profit and get $2, so basically a 10% profit? Oh, this is terrible. I don't want that situation. I don't want to have to take a 10% profit. I mean, you can argue that, well, what if the stock is up 20%? I leave some money on the table, don't I? Yeah. But we want to look at the overall picture here, right? Let's revisit that in a second here. What if the stock is below the strike at expiration? Well, if the stock is below the strike at expiration, the long party, the person who owns the right to buy the stock at 75, is not going to exercise that right if he can buy it at 74 or 73 or 72 or 50. Right? It'd be not smart. So if the stock is below 75, we get to keep the stock and we get to keep the $2, which means effectively our tracked cost effect or tracked cost benefit is it's like we're buying the stock. It's like we own the stock at 68. We actually owned it at 70, but this call expired and we get to keep the $2. So it's kind of like we own the stock at 68. That's not for tax purposes, but conceptually, that's what it's like, right? So our break even, or what we could call our effective cost basis, is $68. That's the stock purchase price, or the price it was when we made the trade, minus the call premium. So far, so good. In fact, if you think about it, if the stock is anywhere below the strike price, we still own the stock and we still have the $2. So we always outperform owning the stock as long as it is below the strike price. And I mean, we actually outperform all the way until it's up to, well, the strike price plus $2, so 77. Arguably between 68 and 77, it's a fantastic trade. But also arguably, even below 68, it's fantastic trade. If we're planning on keeping this stock anyway, we'd lose money anyway, but we lose less this way. Now, let's get back to the big thing that people criticize covered calls for. And when I say people, I mean more novice traders. They say, yeah, but what if it's at 80 or 90 or 100? I leave all this money on the table. Yes, but this is a yes, but. Okay. That should be a word in the dictionary. Yes, but. So, yes, but what if, like, if you think about it, if the stock's at 70, stocks go up, stocks go down. In the long run, there's somewhat of a bias to the upside. The stock market goes up by 10% a year, which is a little under 1% a month. This covered call is probably a month or less. So there's a slight bias statistically on average of this going up about 1%, which would be 70 cents. Other than that, it's about 50-50. So, and as long as it's below 75, even if it goes up some, we still have this benefit. So most of the time, or at least more often than not, we're going to get to keep the $2 and not leave money on the table. What happens then? So now I'm looking for the more experienced folks. I know you know who you are. And Paula, you can tell you're experienced, Paula. What happens after the call expires because the stock is below 75? Well, the call goes away. I keep the $2. And then what I do is you get to sell another covered call. Thank you, Mark. Yes, resell awesome. Dan, sell another call. You guys are all awesome. That's right. Remember, this is the frosted mini wheats approach. Serially sell a call. I'm serious about this. All right. So we sell another call, and maybe we take in another $2, or maybe we only take in $1.80. Maybe we take in $2.10. But then cost basis is a little lower. And more often than not, if we're selling out of the money calls, like if you think about like a bell curve, like I forgot which camera I'm facing here, a bell curve. This is not actually a bell curve. It's actually a log normal distribution because there is that slight bias to the upside. Most of the time, you're going to get to keep the $2. And when I say most of the time, that means more than 50%, probably more than 55%, probably more than 60%. I'm not talking about like 99.999 times, right? But most of the time, you're going to get to keep that $2. So that $2 is going to add up over time. And so the times you leave money on the table, like let's say you skate on these 3 times, okay, and say you collect an average of $2 each time. It's not going to be $2 exactly every time, but just say on average. Well, that's $6 in your pocket. So the time that it does go up and you leave money on the table, we've got an extra $6 sitting on the table. You know, it's like when you go to a bar and you're paying cash. Does anybody pay cash at a bar anymore? I can't remember the last time I paid cash at a bar, but I remember when I was younger, you know, you'd be sitting there with a buddy or two and you'd order a round of beers and you'd drink and, oh yeah, put some cash on the bar and the bartender just kind of leaves it there. Then you order another round and, oh, if there's still enough cash, oh, no, I got put, okay. So, and there's like a pile of cash sitting there, right? Well, this is kind of the same thing. Sure, you're leaving money on the table, but there's a lot of money there already. If I skate 3 times in a row, This point here, which I call the indifference point, which is really where below there, I'm glad I sold the covered call. Above here, I'm leaving money on the table. This isn't $2 anymore. This would be $6. It would be like up here. So it's not 77, it's like 81. Does that make sense? And then, you might leave that money on the table this time and then do it again and take in more. Or you might do very clever things like roll, right? And we can do that. Let's talk about that for a second. So the upside, we limit profit potential on every one given trade, and we might get assigned. But if we do this serially, first of all, it's probably okay just like that. But second of all, we can roll up or up and out or just out. Or we might actually want to get assigned. Hey, I own this stock for like $20. Bought it when the PE ratio is 10. Now the PE ratio is 30. It's kind of expensive. I'm going to sell it. If it goes up a little more, I'm going to sell it. I might want to sell it there. Downside, we're really only doing a covered call if we're okay holding on to the stock. If we're like, oh my God, this stock is going to go down, it's going to crash. I am so worried. It's got 115 PE ratio. It's already down 10% on the month. I think this stock is going to zero. We're not doing covered calls on it. We're just selling that stock and getting out of that mess. So we're only doing this on stocks that we think are going to steadily grind higher, and we're willing to hold it. So the risk, you're not getting any extra risk. You're actually getting less risk by doing this. But, we also need to monitor and actively manage too. I look at stocks in my IRA, which is where I mostly trade my covered calls. I look at them almost every day. I mean, pretty much every day, unless I'm out of town or something. I mean, right now I'm out of town, but I still looked at them today. And if some kind of crazy news comes out on a stock that I own, and it's like, oh boy, there's problems in this, I do monitor it, and I'll just get out of it. Now, managing the upside exposure, the stock can rise through the price. So there's good news and bad news. The good news might be the stock rose through the strike. I was hoping that happened so I could sell it. Or the good news could be, well, I made money. But the bad news is I might leave money on the table on this trade. So how do we solve that problem? Well, if it was our intent to just sell the darn stock, great. Just wait for expiration. Come to Papa. Take my stock. Haul it away from me. Let you gladly have it. Or if I don't want to sell the stock, easy thing to do is I could just buy the call back. Maybe I sold it at 2 and the stock's up a little bit, and I buy it at 2. Or maybe I buy it at 1 and make money on it. Or maybe I buy it at 5 and lose money on it. What does that mean? Well, I've got to sell the call 2 more times to get, well, actually, I've got to sell the call 2 more times to get back the $3 that I lost. Okay. So I would probably do that as a roll. Sold it at 2. The March 75s, I sold them at 2. I buy those March 75s at 5, and at the same time sell the April 80s at 205. That is called a roll. In that case, it's called rolling up to a higher strike and out to a further out expiration. Now we can sell out of the money calls, at the money calls, and in the money covered calls. The most common is out of the money covered calls. By far the most common. And there's a reason for that. It has what is called room to run. If you're taking notes, write that down, room to run. Deja is here. I thought I already saw you. Okay. Thought I'd just let that one hang here for a second. It gives us what is called room to run, right? Room for the stock to run higher. It allows for the biggest share price appreciation. This is keeping my long stock investment, wanting the stock to go up, but just augmenting it, just trying to do a little better on it, which studies show that in the long run, I will. And the study shared on this podcast episode, by the way, that Professor Russell Rode shares, you're going to love. Hey, that guy's super smart. So definitely check out at least this episode of the podcast. But if you like to binge, if you really want to get covered calls down, start from the beginning. Wealth building with options. Okay, so out of the money covered calls, this is on upwardly trending stocks. Usually we don't want to do them at their highs. We can. We're going to ideally set the strike at or above resistance. I tend to like to sell the calls with 45 days or less to expiration. That is because it gives us the highest theta and a minimum premium for the call. In a perfect world, I like to take in at least 1% of the stock price, but I'm not going to lie to you. Really, I would say 0.06% of the stock price is about my minimum. But, it kind of depends too. I mean, if I'm selling a 45-day call, I probably want more than 1%. If I'm selling a 3-day call, I might be good with 0.45%. There's a little bit of a sliding scale based on the time to expiration. Now, for some of you folks who have been around for a bit here, and there's Aslam and Mark and Paula and some of you other folks who've been trading for a while, and you already get a lot of the things we're talking about. Here's a very important thing. In a perfect world, you want to sell covered calls only when implied volatility is elevated. Now, if you don't know what that means, first of all, go back through the archives of the Firstrade webinars on YouTube and check it out. I talk about it in the podcast too, in great detail. If you're not advanced, you don't have to get super hung up on that because in the long run, it kind of works out in the wash. But if you want to trade these with the precision of a surgeon, sell only when implied volatility is elevated. So here, stocks, it's a $90 stock in a little bit of a pullback, but it's a steadily rising trend. Resistance is at 95 bucks a share. So because we own 100 shares, it's at 90. We sell an out of the money 90 straight call at 210. There's a lot like the example that we just looked at. An at the money call, covered call. This is a more aggressive technique, but it's a good one. Okay. We get the biggest time value. And as we'll see when we talk about in the money calls in a minute, time value is what it's all about. This lowers the cost basis the most. This lowers the standard deviation the most. That's what that little stands for. This outperforms long stock the most if you don't get assigned. But it's more likely to get assigned. You have more assignment risk than out of the money covered calls. And I'm not saying risk because it's not likely. It is definitely more likely, but you might want to get signed sometimes, right? Or you might play the game where, hey, I get a sign, but that's okay. I'll just buy the stock back or sell a cash secured put, but we'll talk about that another time. Buy the stock back and just do it again. Or buy back the call, take a small loss because I know I'm taking the biggest amount of time premium and 50% of the time I'm going to be right. So I want to do this on an upwardly trending stock, probably not at the high, but maybe at the high. If I want to sell the stock, maybe at the high. I set the strike at the money, sell a 45-day or less option. Minimum premium requirement, I'm going to want to get a bigger premium. I say 2%. I would say maybe a minimum of 1%. And I say that because if I'm more aggressive in wanting to sell a stock, what I might do is not give it 45 days for the stock to make up its mind or for the market to make up their mind. I might sell one that expired, like I might do it on a Wednesday for one that expires on Friday, like less than 3 days until expiration. Why? Because, the stock's right at the money now. I don't know where it's going to be in 45 days, but in 3 days, it can't be too far from here. And so if it is like a 3-day option, probably not going to get 2%. I mean, if you're selling a 2-week option, a month option, a month and a half option, I might get a lot more. In fact, here, let's take a look for a second here. Let's look at, wait. Amazon. Whoops, typed in the wrong box. So let's see. Today is, what is today? Tax day. Oh, geez. Hope you filed your taxes. If not, I guess you got to do it by the end of the day, right? Or file an extension. So if it's the 15th, well, May 16th is a month. May 30th, that's exactly 45 days. So Amazon, for those of you who are watching this live, is at $180. 1% of that is $1.80. Oh my gosh. I can collect a lot more than 2%. I can sell these at 11.05. Oh my goodness. So 11.05 divided by 180. Yeah, I'm selling those for over 6% of the price. Now, to be honest, I don't go out 45 days that often. I've got some May 2nd covered calls on right now as we speak. Those I can sell here for 8.25. 8.25 divided by 180. It's still 4.6%. Now, there's a lot of factors involved here. Amazon's down. If you're watching this live on April 15, 2025, you'll notice that, this is when the whole tariff craziness is going on. The market's down a lot, it's up a lot. Premiums are high because implied volatility is high, which we need to get back to here. We prefer to sell these when there's elevated implied volatility. So yeah, at least 2%. But oh yeah, let's look at the ones that expire this Friday too. So the April 17th, I can get those. Well, I can get those for, what does that come out to? 2.73 divided by 180. 1.5%. Yeah, and I'd be pretty happy with that. If I was just like, yeah, I'm gonna dump Amazon here. Geez, a free extra 1.5% for waiting 3 days. And I might not even sell it and get assigned. I might just be able to sell another 1 week option on Monday and get, 1.6, 1.7, 1.8%, because there's an extra 2 days, right? So here's a scenario. I own a stock trading at 110. I sell the 110 straight calls. Boom. In the money call. What does that look like? So this is an investment management technique. I have a friend who lives in my town who is super smart. Here's a little thing about me. I really like to hang out with people who are smarter than me, because you're a product of the 5 people you hang out with most. And if you hang out with a bunch of idiots, you're going to turn into an idiot. If you hang out with a bunch of smart people, you're going to get smarter. So anyway, a friend of mine who lives in my neighborhood, he retired from one of the big banks. He was a big trader at one of the big banks, and retired. This is a long time ago by now. He retired. I mean, it's like 40 or late 30s when he retired. And I was like, oh, so what are you doing now these days? He's like, oh, just managing my portfolio. Oh, thanks, secret agent man. Appreciate that. I appreciate your appreciation. So yeah, I asked him, so yeah, what are you doing these days? He's like, well, just, playing catch with the kids and managing our family's portfolio. It's like, oh, cool, man. Like, what are you doing? He's like, well, I do a lot of covered calls. I'm like, oh, that's cool. What's your technique about doing covered calls? Because, I mean, look, man, I've been in trading for over 30 years. No, I've been specifically in options trading for over 30 years. Wrote a couple books on it. Like, I get it, but I'm still learning, right? Once you stop learning, you're done. You're going to start losing money because you think you're smarter than everybody else. I know I'm not smarter than everybody else. I know there's people smarter than me. And so this guy I know is smarter than me. So I was like, hey, so what is your technique for selling covered calls? He goes, well, I look for stocks in my portfolio that I think are overbought, and they're too expensive, and maybe looks at the P ratio, or their cash, or their earnings are going down, or their cash flows are going down. There's a lot of techniques for that. And the stocks that I think are too expensive, I sell in the money covered calls on them. And I was like, wait a minute. You ever watch It's a Wonderful Life? How's that? How's that? For a minute there, I thought you said in the money covered calls. You see Jimmy Stewart saying that? So yeah, so he's like, yeah, in the money covered calls. And I was like, that is the craziest thing I ever heard. Maybe you're not as smart as I thought. But I went home and I thought about it. And I was like, damn, this guy really taught me something. It's a brilliant investment management technique, but you have to get it. I've seen a lot of people make mistakes with this and not get a very important thing about in the money covered calls. And that is, you have to focus on the intrinsic value versus the time value. Only time value lowers your standard deviation or reduces the cost basis, which is what leads to outperformance. Intrinsic value just offsets the share price. I just had a friend of mine text me about this a couple of days ago. I should have just put this text in the presentation. In fact, I'll go through an example and show you how this works. This is an exit strategy. This is not to try and generate income, to try and skate on it. This is, I hope I'm going to get assigned, and I'm going to do this to make it very likely I get assigned. It's basically like a cash secured put. In fact, synthetically, it is a cash secured put. Now, I don't want to spend too much time on that. We'll talk about that in another. In fact, I think I did a webinar with Firstrade on synthetics. Go through their archives on YouTube. So this for an investment I'm looking to sell. I want to generate income, want to sell it at a more favorable price than the current stock. I can set a strike that's poured. I mean, I can set it wherever I want as long as it's in the money. 45 days or less, but really for this, you know what? I'm going to change this. If I'm going to get a, if I want to get it signed, I'm going to say probably 21 days or less. I got to change that. Yeah, I got to change that. 21 days or less. Why don't I want it to be 45 days? Because, you know, like this is when I want to sell. I don't want to wait 45 days to see if I get to sell it. 3 weeks is still an eternity, but I'm okay with it. So the minimum time value requirement of the call is time value is at least 1% of the stock price. The overall premium is going to be more because there's intrinsic value. And I tend to want to sell it at elevated implied volatility. It's not necessary, but I prefer to. So I have an investment stock. I'm looking to sell. I own 100 shares trading at 63. I'm going to sell the 60 calls. So the stock is here. I'm selling somebody the right to buy it from me here. That's crazy. Why would I do that? Because of the big premium. Let's go through this. There's $3 of intrinsic value and 90 cents of time value. So let's say this is a 1 day call. Okay. Stock's at 63. I sell somebody the right to buy it from me at 60. If they do, I'm going to lose $3, right? Own it at 63, sell it at 60. I just lost $3. But the intrinsic value is $3. It is a direct hedge. So I get that and it offsets it. But I also get this extra 90 cents of time value. So it's like I sold it at, well, I actually sold it at 60. I've got $3 of intrinsic value. So I effectively sold it at 63, but I have 90 cents of time value. So I actually effectively sold it at 63.90. It's a way to sell a stock at a higher price. The fact that it's in the money makes it more likely that I'm going to get assigned. And for those of you who look at delta and think about delta as the likelihood of an option being in the money at expiration, hence getting assigned, these are going to have a delta of above 50%. It's more likely than not you will get assigned. All right, folks, that's all we have for today. Come back next week. I love repeat customers. You probably love being a repeat customer too, because it doesn't cost you anything. You just get stuff like brain stuff. What do I think of the covered call ETFs? Aslam, I think they're interesting. I never really looked that. I've looked a little bit into them. Yeah, you're welcome, Dan and Michael. I've looked into them, and the ones that I looked into, and I forgot which ones they were, so I'm not like trying to tell you these are wonderful or anything like that. The ones that I looked into, they had great outperformance ratios. But this was probably at least a year ago. I haven't looked at what they look like in this market now. I mean, intuitively, they're probably down money, but still down less money than the overall market, I would think. So that is a great question. I just haven't looked that much into them just yet. Kind of want to. No, I will. Well, Matthew says they seem bad, UILD, et cetera. They pay fake dividends and erode the asset base. Yeah, I'd have to look at it, Matthew. Yeah, I'd have to look at it. Okay, hey folks, I will talk to you next time. Have a great rest of your day. Bye-bye. See you next week.